into these confusing markets in our closing bell exchange today with Lydon from ETF Trends, Michael Gayed from ATAC Inflation Rotation Fund and Pension Partners, Walt Zimmerman from United ICAP, Patricia Powell from Powell Financial Group, and our own Rick Santelli. Rick, I'm going to start with you today because I'd just like you to put this week in context for us. Is this the bond market's fault?
You know, to put this week in context, let's start at the markets that we should pay the most attention to, which happen to be highly correlated with ours. The DAX last week closed at 91.95. This week it closed at 87.88, down a little over 400 points. The CAC last week, 42.81 and change, closed at 40.73, down over 200. So you get the idea. The 5-year was the winner this week. Its yield dropped 17 basis points. 17, 172 last week, 155 as the crow flies right now. Listen, you in the top in the lead-in said confusing. I think it's anything but confusing. To me, when you have the type of bull market in equities that hasn't had any rollover, hasn't had any corrections, it's not going to go down without a fight. That fight starts with a V, and it's called volatility. We're getting this type of discontinuous market volatility at the top. I don't know. I think as an objective person with no axe in this one, no flesh in the game, it certainly looks like a market in transition. And the more it transits down, the more you're going to see yields follow closely.
Michael, to Rick's point, the VIX is now at an 8-month high. Yes, volatility has picked up. The fear gauge is ripping. Is this going to get worse before it gets better?
I think the answer to that depends purely on the behavior of junk debt, which really is, I think, the source of what's causing this volatility. If you look at the way credit spreads have been widening, junk debt has been falling, treasuries have been rallying. That's the exact wrong combination you want in a bull market. And I do think that it is wildly underestimated how severe this deflation pulse continues to be in the system. We are seeing a questioning of central bank power, omnipotence, what I call the last great bubble. And I think we're at a juncture now where, as Charles Dow would say, the conditions are changing. The one fact pertaining to all conditions is that they will change. The conditions are changing. It's time to fight the Fed, which means employ risk management.
It's time to fight the Fed. Okay, so we've heard conditions are changing, the market's in transition. Patricia, so what's an investor to do?
I think you have to differentiate between what your investments are supposed to be doing. If you're a trader or if you're a speculator and you've put your stops in along the way, you probably were stopped out in the last few weeks, and I certainly was on my trades and speculations. But if you're a long-term investor, then you ride it out, because what you're looking for is not to find the perfect tops and perfect bottoms. You're looking to be in the right investments. Now, to ride out a market like this, we have long been in large cap value and really been out of things like small cap growth, because they don't tend to do well when you're 5.5 years into a bull market and 5.5 years into an economic cycle.
Tom, why has there been so much volatility, especially this week? I mean, the Dow has moved 2,000 points in the last 7 trading sessions.
Yeah, it surely is one of those corrections that makes your hands sweat a little bit. But as Kelly pointed out earlier, it's healthy from time to time. If you took one of those corrections in the past as an opportunity to put cash to work, especially in some of those areas that buck the trend, like Morgan mentioned earlier, consumer staples, utilities, the XLU from the Spiders and the Spider Consumer Staples ETF, XLP, both have been doing quite well in the last 3 weeks during this correction. Both have attractive yields, and if you look at the earnings so far, things look pretty steady. So look at this as a buying opportunity for sure.
But Tom, are you talking about buying into those sectors right now that are working the defensive space, or are you talking about using this as an opportunity to buy in some of the beaten down parts of the market that aren't performing right now?
No, I think for those looking for a more of a defensive play, this is absolutely the place to go. I don't have the guts right now to go in and buy chips at this point or get into technology. But there's still a ton of cash on the sidelines, and earnings are definitely in play.
Tom, good to see you, first of all. It's been a while. Let me just address this issue about defensive sectors. I co-authored a 2014 Dow War paper about the predictive power of utilities. As a matter of fact, I've been on the road the better part of 2 months around the country presenting to CFA and MTA chapters about these award-winning papers, which specifically talk about predicting environments where you can have a correction. When you see utilities outperform the way they are, when you see treasuries on the long duration side outperforming, when you look at consumer staples, you look at healthcare, in our beta rotation fund, we are all in on that in a way no other equity sector fund is. But let me tell you something, there's a signal there that something is wrong with the state of markets and with perception about inflation and growth. The bond market has been screaming all along, The S&P has been wildly disconnected. Small caps have not. They continue to break. One quick point about the S&P and large caps. They tend to be the last to fall. The fact that most people still have gains in large caps, I recommend everyone look up the term, the disposition effect. Studies show that people tend to sell winners first before they sell the losers. The last one standing is the S&P, is large caps, and that is what is extremely vulnerable.
Well, let's come back to that in just a second, too, when we talk about, I just want to bring Walt Zimmerman into the conversation. Walt, why don't you voice, you've heard Michael lay out his concerns, Tom saying maybe it's a buying opportunity. What are you guys doing right now?
We think this bear is just starting to wake up. This week, the Russell 2000 and the DAX both gave a major sell signal from the confirmation of a huge head and shoulders top that targets a 22% loss from the high for the Russell, actually a 28% loss for the Russell, and a 22% loss for the DAX. You have the S&P sitting on its uptrend line from 2011. And I think you have the market putting way too much hope in the Fed's concern over a strong U.S. dollar. Because what's driving U.S. dollar strength is Euro FX weakness and Japanese yen weakness, both of which are completely beyond the reach of the Fed to have an impact.
Okay, so let me just ask then, because we're going to have to go in a second here, but Michael, what do you think then ends this, if you want to call it, as Walt just did, a bear trend, what ends it here? Is it going to take a policy response?
Well, probably a credit event where you shake out all the weak hands. And, you know, in the age of the internet, where everybody has so much information, everybody's a weak hand. Everybody's trading off of noise, not signal. If you have a credit event where junk debt spreads really blow out, like they did an hour before the Dow dropped 1,000 points on May 6, 2010, the flash crash, that is your source of vulnerability. That's probably your buying point, but there's going to be a lot of pain in between.
You sound, how long have you been more negative on the market?
I have been of the deflation thesis since the better part of last year. I have been correct on that thesis when you look at the way Europe is acting, when you look at all these trillions that have been out there that has not worked. The problem for the ECB, the Bank of Japan, the Fed has never been the amount of money, it's the velocity of money. You cannot get people to spend despite all this money that's out there, despite the supposed wealth effect.
Patricia, do you want to get a last word in here? Are you more sanguine?
I really do. I understand what he's saying, but I don't think that matters. I think you're looking right now, 71% of the S&P 500 is trading under their 50-day moving average, and it tells you that it's really the large stocks that have been holding up the index. Not a good sign, but it may mean a correction. The pessimism abounds. I was on a month ago, and the optimism abounded when we were hitting 2,000, and all of a sudden every bear is coming out. The fact is, we go through corrections, and you need to have a plan to get through the correction, how you're going to deal with it, and then what you're going to do with it, how you're going to deal with it at the end. You know, there's a lot of things that have been giving off signals for a fairly long time, but now we're finally here. And you know, what are we off? 3-4% off our highs. You really the Chicken Little of, oh my gosh, the sky is falling. I just can't believe it. You have to be an investor. You have to be able to take a little bit of wiggle room. Some of your stuff may have come off because it was aggressive and it belongs off, but now what you have is left should be your investments, and those are long-term.
Buy and hold at the top. Everyone loves buy and hold at the top.
Walter, I mean, if Lee Cooperman, our good friend, was sitting here, he would say, you know, bull markets don't end because of old age. Corrections don't happen just because they haven't happened in a long time. They end because of recession, and the U.S. economy seems to be picking up, even in the face of what seems to be a dramatically slowing European economy. You want to respond to that notion?
Yeah, on top of that, Scott, let's sit back, take a deep breath. Let's wait for earnings. I mean, 80% of earnings either hit expectations or exceeded expectations. And those are really going to move stocks going forward.
All right, and we're watching the NASDAQ here going into the close. It's worsening, down 1.5% now. And we're closing our poll here as well. We were asking, will the markets rebound next week? And unscientific responses here. The answer seems to be yes, to the tune of 53% to 47%.
Shocking.
Make of that how you will. I think that was Rick there.
Yeah, it was me. Shocking.
Fight the Fed.
Just remember, we don't want to hear three little words come out, but I just think that we may. QE4. I'm telling you, somebody said, is there a policy response?
In which case, it's Japan, Rick. Then we're Japan. We're admitting it.
I certainly hope not, but you never know.
Everybody, thank you. Have a great weekend to the extent that you can. We have 40